welcome to our video series on core power options. Today we'll talk about the technical indicators and we have top 5 to show you.
Before we start, let us introduce ourselves. I'm Jeremy.
And I'm Waimin. We are from Core Invest Institute.
So today's content, we're going to share with you about technical analysis for direction, reversal and timing, ADX DMI, moving averages, support resistance trend, momentum oscillators, and as well as volume.
Before we begin, all the views and opinions expressed here are of the speaker's personal capacity and they are all not meant as recommendation but only for our education and entertainment purpose. Please do your own due diligence, and of course we all know past performance are not guarantee of the future outcome. Material here are all copyrighted. Please do not circulate, copy or duplicate any of the material without our consent. Thank you for that.
So the first thing we're going to talk about is what is technical analysis, right? Basically, is using historical data to try to predict the future, right? What kind of future we want to predict? The direction, whether there's going to be a reversal or timing. So there are long-term period and short-term period. As we can see, for long-term, we are looking at trending periods, right? Trending periods, we mean that we are looking at directional trend that complements the fundamental analysis. Means we are looking at strong companies for long term. And we also look at short-term period, where we are looking at trading periods where we are looking for 0 to 6 weeks of trades, right? Which is mandatory because we need to know during that short period of time what is going to happen to the prices. So directions are very important. Right? To identify the reversal is more important because we need to know exactly at which point of time, which direction we are going to enter or exit in. Therefore, when we look at timing, we need to know that to enter with the right time and exit, which is the right setup, will give us more profit or maximize the profit that we want to go in. So there's this saying, buy low, sell high. But what exactly is low and what is exactly high? So think about it. That is how technical analysis can help us.
So in other words, basically to tell us these 3 important things, the direction, the reversal, potential reversal, as well as the timing. And that is why we use a technical analysis. So now going on to the first of our favorite, right? And it's called the ADX DMI. What exactly it is? ADX stands for Average Directional Index, as the name implies. And it is all talking about the strength of the signal. The next one is called the DMI, and that is commonly known as Directional Movement Index. So as the word implies, it tells us the direction. And there are 2 lines there. It's called the DI plus, which is a bullish pressure, as well as the DI minus, that is called the bearish pressure. So these DI plus and DI minus, they are signals, whether it is going to signal a bullish movement or a bearish movement, as these signals would have strength and it is given by the ADX. The ADX will tell us whether the bullish signal is of a strong, average or weak signal, and the same goes for the DI minus. So combining the ADX and the DMI is a very useful indicator. As you can see on the chart below here, right, you can see 3 lines there. Obviously, the green one we like to use for bullish pressure. The red line is a bearish pressure, while the one that is light blue in color, it is the ADX. So as the interpretation goes, ADX, when it is more than 25, it means it is strong. Above 25, strong. Below 20 is weak. Between 20 and 25 is average. So you want to find companies which are strong ADX because they give you a strong signal. And when you get a strong bullish signal, then you can consider entering a bullish trend or bullish trade. While if you have a strong bear signal, then you might want to consider a bearish trade. So the other important thing is that apart from looking at the ADX currently, what is the current ADX? As you can see for Apple at the moment, the ADX is showing a 24.8. That is almost touching the strong mark. So you can consider entering at that point in time. So apart from looking at the current ADX, you want to go back in time and let's look for a point where you can see the ADX is rising. And that is telling us that there is an increasing strength on what pressure? It is actually an increasing strength on the bearish pressure. Now look at the chart at the top. The price chart is showing that there is a decline in the price, showing that the bearish pressure is in control and with a rising strength. And that is why you can see combining the ADX and the DMI gives you a direction and also the strength of the direction. Okay, so on the next point, on the weakening ADX, can we find on the ADX chart where it starts to weaken? Yeah, at this point in time, you can see that the ADX is weakening. On what pressure? Currently on the bearish pressure. When the bearish pressure is weakening, you can see that the price is actually consolidating at that point in time, and slowly until the bullish pressure, the green line, is overtaking and crossing over that red line. And you can see that that is where the price starts to move up and have overtaken the bearish pressure, and it went up onto the bullish pressure. And of course, what do you see? It is now approaching a resistance line, and that's where we will need to pause and reconsider our position at that point in time, what action to be taken.
So the second indicator that we would like to share with you is the SMA and the EMA. So what are they? They are the simple and exponential moving averages. So as you can see, we are talking about two different kinds of moving averages. So for what does the moving average how does it work? How does the moving average work? Basically, say for example, we are calculating a 200 days moving average, right? Means that it's calculating the 200 candles, right, to plot in the next one. So the last candle will be deleted when they are creating a new one at the front. So what does it mean? That as long as they calculate the last 200 market price movement, they are going to plot the next one, and then be it whether it's going up or down, it depends on the last 200 days average, right? So for exponential moving average, is more of calculating a lot of noise within the price chart itself, whereas the simple moving average calculates lesser noise. Okay, so therefore we always like to use the SMA for a longer term kind of prediction, whereas for the exponential moving average, we prefer it to be short term, because during that short term period of time, it calculates all the noise that we need it to calculate, so that we can have a better understanding of the trend direction.
So by noise, you mean more sensitivity to the recent changes in the price movement?
Yeah, every time we talk about noise is sensitivity, right? The volatility of the market price. So looking at this picture itself, you can see that there are two moving averages over here. One is a 50 and one is a 200, right? And you can see that there is a red line cutting across cutting below the black line, which is called a death cross, and the red line later cuts above the black line, which is called a golden cross. So what are we trying to do? When we observe the 2MA, which is the short and long, the short will be 50 and the long 200, we want to see how can it help us to determine the change, right? So you can see that the short cross below the long. When the short cross below the long, right, we will see what's the cause and effect. Is that if both are sloping downwards, it's going to be a bear trend, right? Bear trend over here. So when the short cross above the long, right, when the 50 cuts above the 200 and both sloping upwards, we are looking at the bull trend. Okay, so this is how we're going to identify where is the trend moving, and we do not want to go against that trend. Additional information will be if the gap is getting bigger, right, it indicates the strength of that trend itself, right? So the bigger the gap, the stronger the bear. The smaller the gap means that there is a chance of reversal, right? And short term, and when we look at moving average, we are looking at short term trade. We will look at the short term moving average, right? And then 200 MA will be a strong moving support, right? Because you are calculating the last 200 days, it's going to be very slow, right? So when it's slow, means that it has a stronger support kind of understanding, and when it touches to the 200, it shows us a greater understanding of how the market price will move. So not only you and I are looking at the moving average, many people are looking at the moving average to determine the point of entry and exit as well.
So in summary, when we see a very sharp drop in the shorter moving average, like the death cross then it's probably a good sign for a bearish entry.
Correct.
And alternatively, for a very sharp upcoming shorter moving average, it's called a golden cross, potential for a bullish trade.
Yes. So we want to trade with the direction and not against the direction.
Let us now move to the next one. One of our favorite here is to look at the support, the resistance, and the trend. So what are support lines and resistance lines? They are called the psychological lines. They are not there, but we have to draw it on our own charts. And everybody who looks at technical charts will need to look at support and resistance because they will tell us the market sentiment. What is support? It is basically the line that is below the current price. When you can draw a line, a horizontal line below the current price, it's called support because it is supporting the bottom. It's called a floor. And if you're drawing a line above the current price, then it's called a resistance line because it creates a resistance for the price to approach or to hit. So normally you need a minimum of 3 touch points, and by touch points we mean a peak or a trough. Okay, so normally price, when it approaches a resistance or a support line, they will test a couple of times, and of course you need other criteria for any breakout of the support and resistance. And one particular important point is to see if there's enough volume or not. If there's enough volume, it will hit and do a breakout of the support or resistance. Let us take a look at this stock called Apple at the moment. You will see that after we have drawn the support and resistance line, right, and you need a minimum of 3 touch points, being either a peak or a resistance. At the price where it is now, it is approaching the resistance line. The question here is, we are trying to use support resistance to find out if there is going to be a breakout or a reversal. So at this point in time, what do you think? Chances are coming to a resistance line, and it is not testing for the first time after a longer period of time. Chances are, without a strong volume, if there's no particular event or any strong incoming volume, there should not be a breakout. Instead, we should see a reversal. Now, if you're not able to draw a support or resistance line, right, typically within 3 to 6 months, if you can't find, then you have to go back in time, whether it's 1 year, 3 years, 5 years. Do whatever you need, go back in time for you to find enough minimum points. And of course, the more points you have, the stronger the support and resistance line. So assuming that you only get 3 peak and trough versus a 30 peak and trough. Of course, the 30 peak and trough is where most people are looking at, and that will be a very strong support resistance, meaning that a breakthrough is difficult when you have a strong support resistance. When the support resistance is weak, the breakthrough chance is higher.
Alright, so to add on to what Wai may have shared, right? So basically for the support resistance, what we want to do at the end of the day is to look out for potential reversal or continuation, right? And this continuation, it can go higher and higher, right? And it can be at a point that is all-time high and you can't even draw the resistance line. Why? Because the price has reached to the highest, and you have to be very careful to think about whether do you want to enter into an all-time high market, because it has not been tested before, and when it drops, it can drop quite heavily as well. So please do understand the risk that you are looking at, and it's always good to find a point where there is tested and proven support and resistance before you enter into any position. That will be much safer for you.
And of course, after you have looked at the support resistance, you want to look at the overall trend. And the trend, you can use a channel. We have a separate video where we will be able to show you how to draw a channel line. So you combine the support resistance, which are horizontal lines, with a channel line, which is at a slope. Combining these two, you will be able to tell whether the overall medium to long term, is it a bullish trend or a bearish trend? And that will give you a better idea in terms of the market sentiments. And of course, that will give you a better conclusion on a potential reversal or a continuation. For example, as what Jeremy says, at all-time high, what do? There's no more resistance for you to draw. Every day is a new resistance. But if the channel trend is still upward, and if you see enough volume and momentum, chances are it will go up if there's no other prevailing reasons for it to drop.
The next indicators that we want to share with you is called the momentum oscillators. And there are three types of oscillators that we're going to share with you. The RSI, Relative Strength Index, the CCI, which is the Commodity Channel Index, as well as the Stochastic Fast. Right? Basically, for stochastic fast and RSI, they are all bounded momentum oscillators. What does it mean? It means that the movement, the indicators will move to 0 and to 100, and they are bounded within that range of 0 to 100. When it's down, means that it's oversold. When it's up, means it's overbought. And that purpose is to share with us that what is the strength of the buyer and seller, so that we can better time our entry and exit. As what we can say, buy low, sell high. So when it's low, this is where we can also look at these oscillators to help us with the decision making. Right, so as you can see over here on the bottom left hand corner, we talk about the stochastic fast. Right, we are looking at basically the bounded momentum, right, which is 0 to 100, and it cannot go any higher. Right, so you can see that the price actually have come down to an oversold here, and this is a good place to buy. And then when it goes up, this is a good place to sell. Right, so if you are doing short-term trading, you want to buy here and sell here, and this can happen within a few minutes, right? And it goes down and up again, and you can see that because its name is called stochastic fast, it is very fast moving, right? So all these oscillators, they are all leading indicators. What do we mean by leading indicator? What we're trying to do is that by looking at, say for example, at this point of time in the oversold, the understanding is that when it's at oversold, the buyers will come in and take control, and the price will go up. So in a way, it's leading because we can understand that if the price is coming down, it should go up. It actually already allow us to predict, that is leading to tell us that it's going to go up. So therefore, it's called a leading indicator.
So Jeremy, why does buyers come in when the indicator is at the oversold zone?
Yeah, so at oversold zone, right, it's actually cheaper to buy in, right? So market price can go lower at this point of time, and again, buy low, sell high. You want to go in at a lower price and exit at a higher price. Therefore, when we are looking at this point of time, we are able to understand that the price will go up, right? Whatever comes up will go down, whatever goes down will come up.
So if we see the oscillators, for example, either the stochastics or the CCI, the price is, the indicators is trending down. So it means that the prices are also getting cheaper.
Yes, correct.
And when it is at the sort of the cheapest zone, then it becomes very attractive for the buyers to enter at that point in time.
Yes.
To cash in on a, as you said, buy low, sell high. And when people starts to buy, prices starts to rise. I see, okay.
And this is where the next thing we're going to share with you, other than the stochastic fast, will be the RSI, right? So the RSI is for mid to long term trading and trending, right? For mid to long term, whereas the stochastic fast will be for the short term trading, which is mostly we can use it for the current day entry, exit, or looking out for reversal. Right, so just to share more on RSI, this is an example for Apple again, this stock of Apple, and you can see that the price is up and down, up and down and up. And in the RSI, we'll be able to observe, right, a same kind of trend as well, going up, down, up, down, up. And you can see at this point of time, as long as it's below the 30, right, it's at oversold, means that the price has come down in a way, right? And this can take some time to come down. It can take weeks or months to come down, right? And therefore, when it touches at this point of time, it shows a very strong indication that the buyers is going to come in, because why? The price is getting cheap already. Therefore, you can see in the next few consolidation period over here, the price went up again. All right. So if you are looking to buy, this is the best time to buy, and you can hold because RSI is for mid to long term, and if you hold, you may not be even looking to sell here, right? Or even to sell at this point, because why? The price has not reached above the oversold, right? Means that there is a chance that the price can go even higher. But however, it didn't go higher, it went down, right? It went down, but it didn't go below the oversold, right? Means that there is also chance that it's going up. And you can see there's a rising indication of buyers when you can see that the price is going up like this over here from the RSI. It shows the strength in the buyer, and it went up all the way to overbought at this point of time, overbought, right? When it goes up to overbought, this is the time where you can think of exiting, because why? You have bought long time ago and the price has went up. Like say for example, you bought at about $120.
That was in March, huh?
Yeah.
5 months ago.
Yeah, and then you sold at a recent time at about 150, and there you go, you make a capital appreciation of $30 USD. If you have 100 stock, you have made 3,000 USD just by holding for a few 2 months or so.
And that's more than 20% of return in about 5 months there.
Yeah, correct. So that is how we look at RSI to determine.
So question, Jeremy, at this point in time, if let's say I'm still holding on to my stock since March, at this point in time, RSI is showing where it is now,
over here.
between it's called the no man's zone between the red and the green line.
Yeah.
What would you do? I'm still having my my Apple stocks.
Okay, so if you can see that the RSI is actually coming down, right? At this point of time, it's coming down. Of course, the price is still at a 150 over zone. If you think fundamentally that Apple is a good company, you can consider to hold, all right? And you don't decide to let it go because it's a strong company. But if you are thinking that it is coming down and you want to collect some profit, why not collect it now and wait for it to drop lower before you think of entering again? At least you can collect some profit and then let it let it be, right? Or another way you can do is that if you are doing options, you can also rent your stock out if you are holding stock, right? Because at resistance, right, this is the best time to rent your stock so that you don't have to sell your stock away if the price is coming down, right? And to add on, that is a sell call options over there, right? And then the next part we like to share with you is called the CCI, the Commodity Channel Index, right? And it is also an oscillator, right? But then the unique thing about it is that it's unbounded, right? Means that it's not restricted like how stochastic fast and RSI is going to be, right? Because that is how much they move, 0 and 100. But CCI it can go above the 100 and the 0 line, right? It can go above 200 to 300 to make it like super expensive. It can even go below 0 to negative 100 all the way to negative 200. That shares with us that it's getting cheaper and cheaper, right? So it's very useful because the stochastic can only show us how low it can go, right? And at the point 0, right? But we do not know how low can it go unless the CCI can tell us, right? So the CCI can continue to go lower and lower, whereas the stochastic fast is at 0. Right, it's still stuck at 0, right? As you can see over here at this point of time, it's still at 0, but it has went down below the negative 100, and it only tells us that it's coming back up only when it reaches to the 0. So that is the interesting part, because you may not know when to enter at this point of time at stochastic fast, but then the CCI will tell us, oh, okay, the price is now really finally coming back up, right? So that is the interesting part that we want to look at CCI. Right, to look at the strength, the direction, whether to add on with the stochastic fast to let us know, okay, it's a good time to enter at that point of time or exit at that point of time.
We talked about timing just now. How do we use these indicators for a bullish entry? For example, at what point for RSI, at what point for CCI do we enter? There's so many lines there.
Correct. So the general answer for looking at RSI, stochastic fast, or even CCI is basically if you want to buy stock or enter a bullish strategy, that is where you want to look at the oversold signals, right? Oversold, because oversold signals tell us that it is a cheaper environment to buy in. And
it means the lower of the two lines.
Yeah, the lower of the two lines, correct. The lower of the two lines over here, right? And that is the point where you want to see that that is the best time to enter rather than entering at the wrong timing where the price is all the way up. Okay, so again, follow the rule of buy low, sell high, and that is where the buy low will give you the advantage of entering in a better price than many others over there. So to add on the CCI, just now we mentioned that at the oversold signal, it can go down all the way to negative 200. But then when is the best time to enter for CCI? Is that you want to see that it's actually emerging uptrend, right? Moving from the negative 100 to the 0, right? So this is the part where you want to see the point of entry, right? Where it touches the 0, that is the best time to enter, because we are going to see a strong bullish push or pressure that is going to push the price up at that point of time.
Okay, on the last indicator here is to use volume. As you know, technical analysis is mainly talking about movement of prices and how the volume correspondingly will drive the movement. So the volume measures the number of contracts or shares that are being transacted over time, and it also shows a kind of a market strength. When the volume is high, it shows that there's a strong strength, whether it is up or down, but it's a strong strength. When the volume is low, it means that potentially it is a consolidating price. So let us take some example. First one here is Pfizer. You look at it. We have drawn, of course, the support and resistance line, as you can see over there. Look at the bottom, the volume. When there is a rising volume, right? At that point, when there is a rising volume with the red arrow there, you see there is a breakout from the first resistance point. If there's not enough volume, the breakout will not happen. So you need volume to drive a breakout. And then it goes up all the way. Of course, that point in time, it is like an all-time high. You wouldn't know that it is a resistance point, because every new candle is a new resistance. But you can see that the price has been developing upwards. And then what happened? The volume starts to decline. When the volume declines, the same goes for the price. The price will also decline because not enough volume to continue to push the price further upwards. So there is a decline. And then it starts into a consolidation phase. Price starts to rise again and coming to the next point where it is close to that all-time high, the previous all-time high. And therefore, we can almost draw a sort of a weak resistance line. Why do I say weak? Because we don't have enough minimum 3 points there. But it's coming to the last peak before. That was about a couple of months ago. And now the question is, will it break out? Now, you will see that there is a corresponding increase in volume at the bottom there. And because of that, there is a strong breakout. And that's how you use for Pfizer. Let's take a look at the second example. This is Boeing, BA. Again, draw your support resistance line. And you can see that correspondingly, there is an increase in the volume driving a breakout. And the next increase in the volume, you can see there's another breakout point there. So it's very important to look at price together with volume. Final example we have here is ERII. Now this is a very interesting stock. It goes up all the way, almost with no break. And then you can see that there is a huge amount of volume interest over there. And that drives another breakout point. Why? Because prior to that, it was consolidating for a short period, right? The first test of the resistance line, it did not violate that line. It was just a slight reversal. They tested again. And now the second test comes at a huge volume. Straight breakout. Then the next one, there was a trial there, but then immediately the price goes down. So there is a breakout, but this breakout might not be too long. But of course, you can see that the immediate decline in the volume also caused a loss of interest there and price went down. So you can use a combination of price versus volume to look at the strength. Continue on, you can see that these are some of the pretty common volume indicators. It is not just a pure volume, but it is a volume indicator. And we will be having another video, a separate video just on volume itself. So in summary, the volume confirms the price trend. Up, down or not, confirms the price trend as as well as the chart pattern. The changes in the volume, higher in volume or lower in volume, leads to a price movement. Whenever there is a decline in the volume, it means that it's weakening on the price, and therefore potential reversal. So the volume indicates interest, right? And therefore momentum of any potential breakout or pullbacks.
Right, so to conclude from my end over here, there's an additional item. So if you want to really look at a strong push, right, not just looking at indications there's uptrend or downtrend, you want to use volume to help us to see the indication of how much the buyer want to push the price up. The stronger the volume, better chance that the price will break out of it. Especially you can use it very useful for channel breakouts. Right, that is going to be something that you want to look at. That volume is going to be that indicator to help you to make a better decision. This is a summary again from the what we have shared today. Right, we talk about the direction, reversal, timing on technical analysis using historical data to try to predict the future. Right, we also share with you the other 5 different hot indicators: the ADX, DMI, the moving average, support, resistance, trend, momentum, oscillators, as well as volume. So most importantly, you do not just want to use one indicator. You can use multiple of it, and but you don't want to use too many, right? Use those that will help you to make a decision, right? I think the best of all, if you want to look at, is basically this top 5 will be good enough to help you to make a good decision whether to time your entry and exit.
Yeah, because any of these indicators will give you a conclusion. But of course, sometimes you get false signals, false information. Therefore, it is wise to take a look at a combination of some indicators to confirm some of your findings and directions. Of course, end of the day, you are looking at direction, potential reversal, and the timing for entry exit. So we hope you have enjoyed this video on our technical analysis series. Other than that, we also have the other series. We have got a video series on the market insights, on low capital investments, on sector analysis that we cover sector by sector, and of course the mistakes and risk management, which are very important for our new friends and new communities.
So if you'd like to know more about the news and updates from us, from Core Invest Institute, if you find there's so much value over here, please scan a QR code. If you'd like to learn and understand more about options, you can always visit our website, Profit with Options. Or if you'd like to join our community in our Facebook, please feel free to join us by scanning that QR code over there at the bottom left-hand corner.
And with the Core Invest Institute, you trade smart, you trade simple, and you trade safe. The way to invest.
Right. Thank you, and see you in the next video. Bye-bye.